What happens if my credit score drops 10 points right before I make an offer on a house? Before you start checking your credit score 17 times a day and giving yourself stress induced eye twitch, let's talk about what actually matters. Because the answer is it depends. I know. It's not that exciting of an answer, and it's not probably the one you wanted. But in mortgage lending, a 10-point drop can range from being completely meaningless to potentially costing you thousands of dollars over the life of the loan. So let's pull back the curtains and look at what is happening behind the scenes. First things first, a pre approval is a snapshot. A pre approval is not a magic golden ticket, it's not a guarantee, it's a snapshot in time. The lender looked at your income, your debts, your assets, your credit profile on one specific day and said, based on what we see today, we're willing to lend you the money for approximately this much. Notice the important phrase, based on what we see today. They didn't promise that nothing would change over the next few months because things can absolutely change. Your income can change, your employment can change, your debt can change, and yes, your credit score can change. So a pre-approval is really a conditional thumbs up based on today's financial picture. Just the other day on social media, I saw a post where a buyer got their offer accepted and decided to celebrate by dropping $10,000 on tickets to a professional playoff game. Guess what their agent said? Call me immediately, because they were not finished buying the house. The truth is, review of how you manage spending and credit is just beginning when your offer is accepted. And blowing 10 grand on a sporting event right before closing is a massive red flag to the lender. That's the hard truth. It just doesn't look good to a lender that you went off and blew $10,000 on a sporting event. The good news is a 10-point drop usually isn't a disaster. Most buyers hear the words credit score drop and immediately imagine an underwriter throwing their mortgage into the file into a shredder. That's not usually what happens. If your credit score drops from 780 to 770, 760 to 750, 745 to 735, you're probably still in very good shape. In many situations, your loan remains the same. Your approval remains the same. Your lender may not even be concerned. The problem is not usually just the 10 points. The problem is where those points land. And that brings us to something called credit score buckets. Mortgage pricing lives inside credit score buckets. Mortgage lenders do not price loans on one point at a time. Instead, they use score ranges. Think of them as neighborhoods. You might be living in this 760 plus neighborhood, 740 to 759 neighborhood, 720 to 739 neighborhood, 700 to 719 neighborhood, and so on. If your score drops 10 points but stays within the same neighborhood, nothing may happen. But if your score crosses into a lower bucket, things can change quickly. For example, let's say your score was 742 and you lose 10 points. Now you're sitting at 732. You just crossed into a different pricing tier. And that can affect your interest rate, your monthly payment, your private mortgage insurance premium, and your overall borrowing costs. And that is why lenders pay attention to the seemingly small score changes. The worst case scenario is that most buyers don't need to worry about this part, but let's talk about it. Every loan program has minimum credit score requirements. For example, certain loan programs may require 620, 640 or higher. And if you are already sitting right at the edge and your score drops below a program requirement, your approval could be delayed until the issue is resolved. Again, this isn't common, but it does happen, which is why your loan officer wants to know about the changes before they become surprises. The real danger isn't the number, it's the why, and this may surprise you. Lenders often care less about the 10-point drop than they do about what caused it. When they review your file, they want to know what changed. Did you open a new credit card? Did you finance furniture? Did you buy appliances? Did you take out a personal loan? Did you miss a payment? Did your credit card balances just suddenly jump? In our scenario, something to consider is how you paid for those tickets. Did you put it on a credit card? And if so, did you raise your debt to income ratio? That could create a different outcome. So here's a suggestion. You're buying a house. That's it. Don't buy anything else. Regardless, the point is the score itself is only a symptom. The lender is trying to identify your behavior behind the score movement. So this is very common, the furniture store trap. This one catches first-time home buyers constantly. You find the house, you get excited, then you walk into a furniture store and the salesperson says, open a card today and save 15%. Sounds harmless, right? But now you have a new credit inquiry, a new account, potentially a new monthly debt. The lender may not be worried about the score change itself. They are worried about your new debt to income ratio, like I mentioned before with the playoff tickets. Remember, mortgage approvals are based on math, and when you add new debt, you change the math. So here's a credit utilization surprise. Another common issue is this credit utilization. Let's say you have a credit card with a $10,000 limit and normally you carry a balance of $500. Then suddenly you book movers, you buy appliances, you reserve vacation plans, you purchase supplies for the new house, and now your balance is $5,000. Even if you pay on time, your score can temporarily fall because your utilization has increased. Many buyers don't realize this until after it happens, but you won't because you are part of the First Time Home Buyer Workshop community and you are going to be empowered. Now, another question is will the lender check my credit again? Lots of buyers assume the lender already checked my credit and we're done. No. The lender will rerun credit typically 2 to 3 days before closing, so you are not done. Some lenders perform soft credit checks, some use credit monitoring systems, some verify that no major new debt has appeared. Some conduct final reviews just days before that settlement. The exact process varies by lender. There's no one way. But assuming that nobody is watching anymore would be a mistake because they often are. What should you do if your credit score drops? First, don't panic. Second, don't try to fix the problem yourself. Don't open new accounts. Don't close old accounts. Don't start moving money around. And definitely do not take advice from your cousin's neighbor who bought a house in 1997. Instead, call your loan officer to tell them exactly what happened. Say to them, I noticed my credit score dropped about 10 points. Can you please tell me whether this affects my pricing bucket, interest rate, PMI, or qualification? Mortgage professionals deal with these situations every day. Most of the time, they can quickly tell you whether you have a real problem or simply just a temporary fluctuation. You will be in mortgage lockdown mode when you're buying a home. And one of the best pieces of advice I can give you for first-time buyers is this. Once you're pre-approved, put your finances into what I call mortgage lockdown mode. Until you have the keys in your hand and the deed is recorded, don't open a new credit card, don't finance furniture, don't buy a car, don't co-sign for anyone, don't miss any payments. I'm doing a lot of don'ts, huh? And don't max out your credit card. Just keep everything as boring as possible. This is one of the rare times in life when boring is beautiful. One time I had a client and it was their first anniversary and they were in the middle of buying their house. So instead of going to a B&B and taking a quick trip, they shopped for a fantastic meal at their normal grocery shop, made it at home, and fixed up their second bedroom in their apartment as their getaway. No dings on the credit card or cash, and they creatively celebrated their anniversary without ruining their mortgage approval process. Oh, brilliant. Overcoming the home buyer overwhelm. Notice how one simple question, what happens if my credit score drops 10 points, suddenly turns into a discussion about credit scoring, mortgage underwriting, PMI, debt to income ratios, loan pricing, and credit monitoring. And this is only one question. This is exactly why first-time homebuyers often feel overwhelmed. You are probably highly skilled in your own profession. Yet the moment you decide to buy a home, you are expected to understand 5 areas: what real estate agents do and know, and everything about that process. Mortgage lenders, what they do and know, and everything about their field. Home inspectors, same thing. Appraisers, same thing. Title companies, real estate attorneys, insurance providers. Each profession has their own different rules, regulations, products, and responsibilities. And trying to learn all of that while making one of the largest financial decisions of your life is a perfect recipe for homebuyer remorse, in my opinion. So unlock the key to homebuyer happiness and try learning what you need to know while making the largest financial decision in your life is the perfect recipe for homebuyer remorse. But you don't have to learn this through expensive mistakes. If you want to take control of your journey, join our free class, Homebuying Chaos Unwrapped, and you'll learn exactly who does what, why, when, and how, and why they do it. And the entire process that's working behind the scenes, so you can step into home ownership with absolute confidence. Click in this description below to claim your free spot. I'm Julie Marion, founder of the First Time Homebuyer Workshop, and I can't wait to meet you. Bye for now.